So, as you can see in the handout, we treat an interest in a partnership as a property separate from the underlying partnership property for income tax purposes. And in essence, it's the same as the share, a share of a corporation or a unit of a mutual fund trust for income tax purposes. For our purposes, we're going to assume that nobody trades in partnership interests. So we're going to assume that the partnership interest is always a capital property. And, as you would have learned in baby tax, any disposition of a capital property is going to give rise to a capital gain or a capital loss, depending on the proceeds of disposition relative to the ACB of the property. So the slide asks how you would incur cost in a partnership interest. And there's really two ways that you can do this if you ignore Section 53, right? Section 53 are the provisions that adjusted cost base. If you ignore Section 53, then adjusted cost base is just your cost otherwise determined, which is a common law concept. And your cost otherwise determined is one of two things. It's either what you paid to buy the partnership interest off of somebody else, or it's what you contributed to the partnership at first instance to acquire the partnership interest. So two ways you can get cost. This is not always an academic question. There was actually a case in 2019 and 2020 at the tax court and federal court of appeal levels called Iberville Developments, where this distinction between cost and adjusted cost base became highly relevant. And in that case, they tried to double up their ACB. It was actually a remarkably stupid tax plan that probably should not have gone into a courtroom, but I guess somebody in Quebec was very bored. In any case, it's not entirely hypothetical. The real world, more scary place where the distinction between cost and ACB becomes relevant is in the context of the tax shelter rules, because the tax shelter rules do reference cost and not ACB. And so if you're worried about potentially having a tax shelter in relation to a partnership interest, you really want to make sure that you know what your cost absent Section 53 would be. So that said, we can go on to slide 17 in our materials now. And what we're talking about on slide 17 is how, unlike a share of a corporation, the ACB of a partnership interest has to be adjusted to the extent that gains or losses are allocated to the partners by the partnership. If there was no adjustment and the partnership's distributions were not exactly equal to its income allocations, and then a partner could be double taxed on a disposition of a partnership interest to the extent that there were previous distributions of income. So to kind of illustrate this with an example, suppose that we have a partnership with two equal partners that earns $1,000 of business income. Okay, and so the result of that is it has to allocate that business income. So it does so 50-50. So each of our individual partners picks up $500 of taxable income from the partnership business and has to pay tax on that amount. And let's suppose the partnership, as many businesses do, does not distribute the cash and instead just plows it back into the partnership business. And let's say it acquires a new asset using that $1,000. So as a result of doing this, the fair market value of the partnership interest has gone up. Between the two partners has gone up by a combined $1,000. But if there was no adjustment to ACB, then their ACB would just be effectively, let's assume, zero, right? And so if they then went to sell the partnership interest, then what would happen is they would have a combined, again, a $1,000 capital gain, $500 each, and 50% inclusion, so $250 capital gain for each of the two partners. But that's the amount they've already paid tax on. right? Like that $1,000 of fair market value is attributable to a tax paid asset, in respect of which the partners have already paid tax. So they are being double taxed if we don't have an adjustment to the ACV of their partnership interests. And so this is what we're trying to fix from a tax policy standpoint when we adjust the ACV of partnership interests. So moving on to slide 18. Now that we've identified the problem that we want to deal with, we can see how it works. And basically, the problem can be solved through 5 separate adjustments, upwards or downwards. And they're listed in the slide, on the slide, they're listed in the handouts as well. And if you're looking at the Income Tax Act, all of these adjustments are in paragraph 53(1)(e) and paragraph 53(2)(c). So upwards is 53 sub 1, downwards is 53 sub 2. So that's a place to look if you're following along in your act. So the way conceptually these things would work is that any taxable amount gets added to ACV, deductible losses get deducted from ACV, capital contributions to the partnership get added to ACV, cash withdrawals from the partnership or distributions from the partnership get deducted from ACV, and any amount that would is a non-taxable income amount would increase ACV, and any amount that is a non-deductible economic loss will reduce ACV. So, the first 4 items I think are fairly self-explanatory, and if you've been following, or if you've understood what we've talked about so far, you'll understand why those first 4 adjustments happen. The last one is a little bit less intuitive, and I think needs a bit of explaining. So, think about, if you had a tax-exempt amount that was received by the partnership, and there was no ACV adjustment, one of 2 things would happen, and both are bad. So let's say, for example, the partnership receives let's suppose the partnership receives a life insurance death benefit, which generally speaking is non-taxable when received. So in that case, one of 2 things would happen if there was no ACV adjustment. If the partnership didn't distribute that amount and it, again, reinvested it in the business, then the fair market value of the partnership interest goes up by the amount of the life insurance death benefit received. So there's now an accrued capital gain on the partnership interests. And so if the partners then sell the partnership interests, they're going to realize that capital gain, and we've effectively converted a non-taxable receipt into a taxable capital gain, which is no good, right? Option B here is that the partnership could take the life insurance death benefit and distribute it to the partners. But if there's no ACV adjustment for that non-taxable amount, then our distribution downward adjustment is going to kick in on the distribution of the cash that that was received as part of the life insurance death benefit. And so now we have a negative adjustment to ACV as a result of the distribution of our non-taxable amount. And again, what that's going to do is one of 2 things: is either going to create a larger accrued capital gain on the partnership interest by reducing the ACV, or it's going to push the ACV negative and result in a deemed capital gain. Either way, we have the same problem where we've turned this non-taxable receipt into a either future or current taxable capital gain. So again, not a great outcome. And conversely, if we didn't adjust for non-deductible losses, then the same thing would happen, but in the other direction, where things that reduce the economic value of the partnership would reduce accrued capital gains on the partnership interest if there was no ACV adjustment. and would, as a result, you would convert a non-recognized loss into a reduction of an actual accrued capital gain, which is, again, not a great result. I mean, great result for the taxpayer, not a great result for everybody if we allow people to do that to reduce capital gains. So moving on to slide 19 then, and this is handout number 3, question number 4, and we're going to see here how these adjustments work a little bit. So in question number 4, we have partnership XYZ, which earns $300 of business income. Partnership X's share of this income is $100, which is taxable under subsection 96(1), as we would expect. X does not receive a distribution of the $100 of income, and it remains in the partnership to be reinvested. And so the first question is, what happens if X sells a partnership interest and the partnership income is not added to the ACB of the interest? And what's the result if the ACB is added to the interest? So this is exactly what we talked about, right? On the last slide, is that if there is no adjustment to the ACB of the interest, in respect of this $100 of income allocated, then partner X's ACB goes, and partnership X's ACB does nothing, but the fair market value of partnership X's interest should theoretically go up by $100, representing the partnership income that was earned and reinvested in the business to acquire tax-paid assets of the partnership business. So as a result, if X then disposes of the interest, X is going to realize a capital gain of at least $100, and there's going to be, so effectively we've again converted an amount that we already paid tax on into a capital gain. So we're being taxed on the same amount twice. This economic double taxation is not juridical double taxation. So 248(28) of the Income Tax Act isn't going to stop this from happening. But it's no good, right? This is just, it's an offensive result from a tax policy standpoint. Whereas if we have an adjustment to the ACB of partnership X's interest in the partnership, it would go up by $100 as a result of the allocation of income with no corresponding reduction for distribution. So now when the fair market value of the partnership interest goes up by $100, the ACB has also gone up, so there's no accrued gain or loss on the partnership interest. So now if partner X sells the interest for $100, then there's no gain or loss realized, and we've only paid tax once. So that is, conceptually the correct result, and so, normatively the correct result. So we now have that result because of the adjustment to ACB. So that's the idea, and yeah. So then part B of the question asks, well, okay, what happens if instead of X's distributive share being $100 of business income, X's distributive share is $100 of business loss? And again, conceptually, the answer should be the same, but in reverse. So if that loss is allocated to X, and X is entitled to deduct the loss against income from other sources, then the ACB of X's partnership interest should be reduced by $100, which represents, in a way, the real economic loss of the partnership and the reduction in the value of the partnership interest, as well as the loss that X received that was, created other tax benefits as a result of being deducted against income from other sources. So again, that's conceptually where we want to get to. And then finally, again, the question, part 3 of the question is just reiterating that we want the same thing to happen with a non-deductible loss. So, let's suppose here that we've realized a $200 capital loss, or we realized a $600 capital loss. X's distributive share of the capital loss is $200. That means there's $100 of non-allowable capital loss, which is a normally a tax neutral event. So like that's a real economic loss for the partnership. And so, like we talked about, if the normatively correct result should be that X's ACB in X's partnership interest should be reduced by the $100 of non-allowable capital loss on the basis that that nevertheless is a real economic loss. And if we didn't allow an adjustment to ACB, then we would be reducing whatever the real accrued capital gain on that partnership interest is, because we haven't accounted for the actual losses of the partnership. We've only accounted for the taxable portion. So that's the idea there. So again, it kind of is highlighting why we should do that. So again, if anybody is not following his questions, do throw the hand up, or like I said, voice of God me on this thing. But if everyone's okay, we can move on to slide 20. And slide 20 is getting into question 5 on handout number 3. And it's asking what the purpose of various provisions in paragraph 53(1)(e) and paragraph 53(2)(c) do. So I mean, if you cracked open your act in advance of today's class, you already know the answer to these questions. If you didn't, I'll go through it right now. So subparagraph 53(1)(e), this is one of the really important ones. This is the positive ACB adjustment for the income of the partnership that's been earned in a fiscal period of the partnership ending before the particular time. Subparagraph 53(1)(e)(2) is an increase in the partnership ACB by the amount of any capital dividend that's been received by the partnership before that time and allocated to the partner. So you don't know what capital dividends are yet, but we're going to cover that in a few weeks. Moral of the story is a capital dividend is just, it's a tax-free distribution that corporations are allowed to make in some instances. So again, that's an example of a positive distribution as a result of a tax-free receipt by the partnership. Subparagraph 53(1)(e)(3) increases the ACB of the partnership interest by the exempt amount received by the partnership in connection with a life insurance policy. So again, we just talked about that as the death benefit under a life insurance policy being tax exempt. And so that's another example of an upward ACB adjustment to account for a non-taxable amount. And then subparagraph 53(1)(e)(4) increases the ACB of the partnership interest by the amount of any capital contribution made to the partnership by the partner prior to the particular time. So again, that one's pretty straightforward and again, really intuitively obvious, I think. Moving on to the reductions. Subparagraph 53(2)(c)(1) reduces the ACB of the partnership interest by an amount equal to the loss allocated to the partner by the partnership for a fiscal period of the partnership ending before the particular time. Subparagraph 53(2)(c)(3) reduces the ACB of the partnership interest by the amount of the charitable donations allocated to the partner prior to that time. And so again, that's an example of an amount that isn't deductible by the partnership, because again, the credits get dealt with at the partner level, but where we have an adjustment to the ACB of the partnership interest for an amount where there has been a real, a real economic reduction in the partnership's assets as a result of the charitable contribution, and we see that reducing the ACB of the partnership interest. Subparagraph 53(2)(c)(5) reduces the ACB of the partnership interest by the amount of any distributions received from the partnership. And then finally, subparagraph 53(2)(c)(6) reduces the ACB of the partnership interest by the amount of any investment tax credit that's been allocated, which you don't care about, and we don't care about. So that's great. Part 2 of question 5 is then asking about, these clauses that we see on the slides, clause 53(1)(e)(1)(a) and clause 53(2)(c)(1)(a) and what they do. And, these again are examples of non-taxable amounts increasing or decreasing ACB. And so what happens in clause 53(1)(e)(a) and 53(2)(c)(1)(a), they provide that when you have a capital gain or loss of the partnership that's being allocated to the partners, for the purpose of adjusting the ACB, you disregard the fractions in paragraph 38, in section 38. And so again, as you'll recall from baby tax, the fraction in section 38 provides that only 1/2 of a capital gain or 1/2 of the capital loss is taxable or allowable, as the case may be. And so by disregarding that fraction in computing the ACB of the partnership interest, the full amount of the capital gain or the full amount of the capital loss realized in a fiscal period of the partnership ending before that time will adjust ACB upwards or downwards. So if we're all good there, then we can move on to slide 21. And this is handout 3, question number 6. And what we're asking in handout number 3, question number 6, is why paragraph 53(2)(c)(5) exists. So if anybody wants to take a stab at that one, feel free. All right, well, seeing none and recognize we have like 10 minutes before our scheduled stop time, what paragraph 53(2)(c)(5) does is it reduces the ACB by the amount of any distribution that's been received from the partnership before that time. And the rationale for that is that that's just a reduction in the economic assets of the partnership. So to use an extreme example of what would happen if we didn't have this provision, suppose our partnership had 2 assets. One is $100 of cash, and one is $100 of worthless securities. They for whatever reason, they've just gone to zero value. And let's suppose if we have no adjustment to ACB when distributions occur, the partnership could distribute the $100 of cash to the partners, and if they have ACB of $50 each, then they've taken out the cash, and there's no there's no gain or loss there, and they still have $50 of ACB. Then they could sell the interest in the partnership to somebody else for $0, which is what the interest in the partnership is now worth, and they could realize a $50 capital loss each on that, so $100 capital loss in total. And then the person who acquires the partnership interest could wind up the partnership, or just the acquisition would cause the partnership to dissolve by operation of law. And on the dissolution of the partnership, the buyer would realize the $100 capital loss on the worthless securities. So in effect, we're realizing the same capital loss twice. And so by reducing the ACB of the partnership interest when we distribute our cash, we're preventing results like that. And we're also, again, making sure that the ACB accurately reflects the contributions to the partnership less the withdrawals from the partnership. And then there's a second question asking if this is truly a non-taxable event, and the answer is that a withdrawal from the partnership kind of is and kind of isn't a non-taxable event. If you're a limited partnership, if you're a limited partner and it pushes your ACB negative, a distribution is not a non-taxable event because you'll realize a capital gain. In other cases, because the distribution pushes your ACB down, it just increases a future tax liability as a result. So it's more of a deferred tax event than it is a tax-free event. But that's a pretty academic point at the moment. So moving to slide 22 and problems 7 and 8. We can vary, well, we probably don't have time to do both. Probably don't have time to do both. But let's give it the old college try. So in problem 7, we have individual X acquired a partnership interest for $10,000, fiscal period 2021, which is the calendar year, so we don't have to worry about off-calendar year fiscal periods. We have $30,000 in business income, $7,500 of capital gain, taxable capital gain, $5,000 of capital dividends, $5,000 of charitable donations, and $10,000 of withdrawals from the partnership. And those are all partner X's distributive share of those amounts. So the question is twofold. What happens with the ACB on December 31, 2021 and January 1, 2022? And what the problem is trying to drive at here is that every adjustment to partnership ACB has different timing, right? So, our opening ACB here is $10,000. So what we need to look at is when each of these items hits the partnership ACB. So the amount of the capital dividend, which is dealt with in paragraph 53(1)(e)(2), that hits immediately, right? So there's an immediate adjustment to ACB when that capital dividend was received by the partnership. So by December 31, 2021, X's ACB has gone up by $5,000 on account of the capital dividend received by the partnership and allocated to partner X. Similarly, under subparagraph 53(2)(c)(5), the $10,000 of cash withdrawals also hit immediately. So those are actually the only two items here that would hit immediately. So we know that on December 31, the ACB would be $5,000, right? Which is the opening 10 plus $5,000 of capital dividends, less $10,000 of distributions. The other items, which are the business income, the taxable capital gain, and charitable contributions, those all hit ACB immediately after the end of the partnership's fiscal period in respect of which those amounts were earned. So that means that on January 1, we have to adjust our ACB up, our opening ACB on January 1 of 2022 is $5,000. And then we have to adjust it upwards by $15,000 for the business income, $15,000 for the capital gain, because remember, under clause 55(1)(e)(1)(a), we have to disregard the fraction. And so our $7,500 taxable capital gain becomes a $15,000 gross capital gain. And then we have to subtract the $5,000 of charitable donations. that were made as well. So that brings us back down to a new ACB on January 1, 2022 of $45,000. And so the takeaway here, and part two of the question, which I'm just going to skip, it's driving at the same thing, which is that you have to be very, very careful with the timing of your partnership transactions, because you may or may not have the ACB that you think you have, because you have to watch when amounts get added or subtracted to ACB. In real life, this becomes very important when you have a limited partnership that is distributing cash as it's earned, but where doing so would push your ACB negative because the cash distribution reduces ACB right away, whereas the income that was associated with the cash that's being distributed doesn't increase ACB until January 1 of the next year. And so you've got to be very careful in those situations that either you're not distributing the cash or you're distributing the cash as a loan and then setting it off after the end of the fiscal period once your ACB has gone up, and making that set off the effective distribution. CRA is, we have one file right now where CRA is auditing that and arguing that that doesn't work anymore, but that's generally their position is that that's fine. And there are thousands upon thousands of LPs that do distributions that way. So, but that's the general idea, is you have to watch that stuff vigilantly, because otherwise you're going to have capital gains for the limited partners created by timing mismatches, which isn't great. And then, yes, can I go over the 2022 adjustments to ACBN? Absolutely. So again, our 2021 adjustments to ACB, like I talked about, were the capital dividend, which caused an increase from the opening ACB in 2021 of $10,000 to $15,000, and then the cash distribution in 2021, which again, immediate ACB adjustment, taking the ACB from $15,000 down to $5,000. So that's our opening ACB on January 1 at the very first moment of let's say the very last moment of the day. On December 31, 2021, our ACB is $5,000, right? Then on January, at the very first instant of the day on January 1, 2021, all of the other ACB adjustments happen. So we have our $30,000 distributive share of business income. So that increases the ACB by $30,000. We have our capital gain, which the taxable portion of the capital gain was $7,500, which means that the actual capital gain before we get into the Section 38 fraction was $15,000. And so since subparagraph 53(1)(e)(1)(a) requires you to disregard the fraction, then it's the $15,000 total capital gain that matters. So that increases the ACB by a further $15,000. So now we have $45,000 of positive ACB adjustment. So we're plus the original $5,000. We're now up to $50,000. And then we have the charitable contribution to deal with, and that reduces the ACB of the partnership interest immediately after the end of the fiscal period, which a charitable contribution is made. And so that takes us down from $50,000 to $45,000, which is our that's our ACB after the first moment of the day on January 1, 2022. So no problem. So the last point I wanted to cover, which I'm going to do this very quickly, so I know we're out of time, so just please indulge me briefly so we can finish partnerships and never talk about them again after today. What the last slide is getting at is one of the ways the Income Tax Act solves this timing problem, right? Like, let's suppose you were a partner of a partnership for a portion of the partnership fiscal period, and in that portion of the partnership fiscal period, The partnership earns, in our example, we're saying $15,000 of business income. But you want to sell the partnership interest before the end of the fiscal period, which is when the ACB adjustment would normally happen. And for whatever commercial reason, you cannot wait to do it. So the Income Tax Act obviously recognizes that it's kind of a garbage result, that you could be finally disposing of the partnership interest and not get the ACB adjustment for income that the partnership might try to allocate to you. And so the way this problem is solved is a combination of subsections 96.1.1 and 96.1.01. What they do is subsection 96.1.1 permits an allocation of income to a retiring partner, which doesn't mean like an individual retiring. It just means anybody who's ceasing to be a partner or has ceased to be a partner during the fiscal period can be allocated income of the partnership. And then subsection 96.1.01 effectively provides that for the purpose of determining the partner's ACB on the disposition of the partnership interest, the partnership's fiscal period is deemed to have ended immediately before the time that's immediately before the time of the disposition. And that was not me stuttering. That was actually, that is an immediately before the time that is immediately before the time. The Income Tax Act does that. Sometimes it's strange, but in any case, you have a deemed fiscal period end immediately before the time. It's immediately before the time that the partnership interest is disposed of, and therefore at the time of the disposition of the partnership interest, then you get to add that, in this example, $15,000 of business income to the ACB of the partnership interest. So the partner will pay tax on the $15,000 of business income. And when they compute the capital gain from disposing of the partnership interest in filing their tax return, their ACB is going to go up by $15,000. And as a result, the capital gain will go down by $15,000. So that is question 8. And that is effectively the end of partnerships. So when we come back to corporate tax next week, we'll talk about actual corporations. If anybody has anything else on these materials that you want to ask now, we can deal with it now. And if not, we can all sign off and enjoy our weekends. Okay, we have a question. Not able to open or record, and you're recording each other in this chat. Is everyone having the same issue? Will they be sharing this from yeah, so I'm going to try to stick these recordings on a SharePoint or something. I will see what we can do. So rest assured I am on it in as much as I'm on anything. Okay, well, if that's it, then I'm going to stop this recording. And alrighty, well,